Okay, so let us start with the next topic under the techniques of costing. The next topic do we have is standard costing and variance analysis. Topic number 6.2. One of the most important topic in the examination point of view. The weightage of this chapter in group 1 is 10 marks. The weightage of this chapter in the group 1 is 10 marks. In the group 2 is 15 marks. The weightage of this chapter in the group 1 is 10 marks and the group 2 is 15 marks, the weightage of this chapter. The same topic will be continued to the group 2 also. The same topic will be continued to the group 2 also. So, what do you mean by this standard costing and what do you mean by this variance analysis? So, let us study in depth. What do you mean by first definition under this chapter is standard cost. What is the meaning of standard cost? It represents the cost which is which is developed by the business organizations over a longer period of time, expected to be incurred. So, what do you mean by standard cost? Standard cost is nothing but it represents the cost which is developed by the business organizations over a longer period of time, which is expected to be incurred. In any business organization, standard will be there. In any business organization, standard will be there. Standard is nothing but expectation. Standard is nothing but expectation. You are studying CMA, right? So, you are writing your CMA exams. What is the ICMA expectations on you? ICMA is expecting out of 100 marks, they are not expecting 100 out of 100. They are giving you 100 marks question paper and they are expecting from you 40. That's all. Means a person who is technically scoring 40 and overall 50 marks in a subject. A person who is technically scoring 40 and overall percentage is 50, then technically he is said to be a qualified CMA, a cost and management accountant. So, in order to become a cost and management accountant, what is the standard which is expected by the institution here? The standard which is expected by the institution is nothing but 50% they are expecting. How much? 50%. A person who is scoring 50%, technically he is said to be a qualified cost and management accountant. That is called standard. Not only CMA, CCA. In the case of CA, what is the technical estimation which is expected? What is the technical estimation which is expected by the ICAI Institute? 50%, same as it is like CMA only. If a person has to score 40 and overall 50%, then technically he is said to be a qualified chartered accountant. So, with this standard will remain same for each and every business organization within the same industry. Within the same industry, whether the standards will remain same for each and every business organization, the answer is no. The answer is no. Within the same industry, each and every company is having their independent standards. Each and every company is having their independent standards. Although they are within the same industry, belongs to the same industry, but the standards which is set by the organization depends upon one organization to another organization. Like example, sir. Let us take one example. Education industry is one example. It's better you will understand. Okay now. Education industry is one example. Okay now. In this, in this education industry, if you see, okay na, in this education industry, CMA is a one course, right? CA is also related to education only, and CBSE is also related to education only. PUC is also related to education only. Correct ma? CMA is also related to education only. CA is also related to education only. CBSE is also related to education only. PUC is also related to education only. In the case of CMA, what is the expectation of this ICMA institute from the students? They have to score 50%. They have to score how much percentage? 50% they have to score. Means if a student is scoring 50%, technically he is said to be a qualified cost and management accountant. They are not expecting 100 out of 100 here. Out of 100, they are expecting 50. Next, in the case of CA, what is the standard which is expected by ICAI? 50%. Means technically a person is said to be a chartered accountant. So what is the technical estimation which is expected by ICAI? The technical estimation which is expected by ICAI is 50%. Next, in the case of CBSE, what is the technical, what is the standard which is expected from the students here? 35%. Means if a person is scoring 35% out of 100, then technically he is said to be a qualified student in CBSE background. Next, if a person is a PUC student, what is the technical estimation which is expected for a board? 30%, PUC board. How much? Means out of 100, if a person is scoring 30%, technically he is said to be a PUC qualified student. Means here CMA, CA, CBSE, PUC all are related to education sector. All are different organizations. All are different educational organizations. If you see the standards which is set by those organizations are different. Okay na? So this is the best example to set that. So although manufacturing organization belongs to the same industry, but the standards will be different. Sir, who will be fixing the standards, sir? The standards will be fixed by themselves. The standards will be fixed by themselves. Sir, whether the standards are fixed within the first day itself only, sir? The answer is no. The standards are developed over a longer period of time. The standards are developed over a longer period of time. They will start with something. This will keep on changing. At last, one standard they will reach and they will maintain it as a standard. They will maintain it as a standard. That is only called as standard cost. Standard cost represents the cost which is expected to be incurred or which is developed over a longer period of time. Sir, how does the standard cost will be fixed, sir? We studied in the labor cost 2 studies, do you remember? In the employee cost, we studied 2 studies. One is motion study, one is time study. Do you remember that time study definition, what I told you? Time study is nothing but the same job will be given to hundreds of people. The same job will be given to hundreds of people and they will record the time, how much each and every single person is taking. Based on that timings, they will average and develop one standard time. That is only here standard cost. That is only here standard cost. Okay na? So standard cost is nothing but it represents the cost which is expected to be incurred. That is called standard cost. Okay na? Next, actual cost. Next one is actual cost. What do you mean by actual cost? It represents the cost which is actually incurred during a given period of time. It represents the cost, what ma? It represents the cost which is actually incurred during a given period of time. That we will call it as a which cost? Actual cost. That we will call it as a actual cost ma. Now CMA is expecting 50%. Standard they are expecting 50%. Like there are 3 students like P, Q, R. Okay na? There are 3 students who wrote CMA exam. Okay na? There are 3 students who wrote a CMA exam. One person is P, another person is Q, another person is R. Okay na? There are 3 students who wrote their CMA exam, P, Q, R. So what is the standard which is expected by the CMA? The standard which is expected by the CMA is 50%. Now let us see their results. P result, Q's result, R. P scored 58%, Q scored 46%, R scored 70%. So this is their results. Okay na? This is the results. P scored how much? 58%. Q scored how much? 46%. R scored how much? 70%. Okay na? Now if you see here, what is the standard which is expected CMA? 50. But what is the standard they achieved? 58. So that is nothing but they achieved more than the expectation. They achieved less than the expectation. Their achievement is more than the expectation. That is nothing but he is having a positive thing here. He is having a positive result here. So how much is the positive here? 8% more he scored. 8% more he scored more than the expected. More than the expected, he scored 8% more. This is called a favorable situation for the organization. Profitable situation for the organization. So favorable situations in standard costing is represented technically by the alphabetical letter F. If there is a profit, we won't write profit, Nana. If it is a favorable situation, what we will do? It is technically indicated by the alphabetical letter F. Next, 46% Q scored. Q scored 46%. 46 is nothing but less than 50. 46 is nothing but less than 50. So that is nothing but 4. Standard is 4. Standard is 50. But he got 46. He scored less than the standard. That is nothing but he failed in the examination. So 4% which he got negative here. That negative is indicated by the alphabetical letter A, adverse. Why? Because if a person is getting a negative impact in the organization, that is called adverse situation. Adverse situations will create a negative impact on the organization. So it is technically indicated by the letter A. Next, R scored 70%. R scored 70% means expectation is 50. More than 50 only he scored. So that is nothing but 20% he is in favorable situation. It is indicated by the letter F. It is indicated by the letter F. So this is how we will analyze the actual results. This is how we will analyze the actual results. Understood? Actual is nothing but what did they got actual, what did they actually performed, that is called actual. Here actual cost means what did they incurred actual. Expectation many will be there, but actual will be different, right? While writing CMA exam, in cost accounting you will expect I want to score 100 out of 100, but the reality grounds will be different, right? Actually you may score only 70 or 80, 90 also, 95, like that. Depends upon your performance level, depends upon your hard working level. So all these factors will be there. So this is called as a which cost? Actual cost. Next, when we are comparing the standard cost with actual cost, the difference between the actual cost and the expected cost, that will call it as a variance. That will call it as a what? Variance. Okay na? Next definition do we have is variance. What do you mean by variance? Comparison of difference between the actual and standard is known as variance. Comparison of difference between the actual and standard, it is known as what ma? Variance. Next one is variance analysis. What do you mean by variance analysis? Okay na? What do you mean by variance analysis? Comparison between the standard and actual is known as what ma? Comparison between the standard and actual is called variance. Then what do you mean by variance analysis? Okay na? The process by which the total difference between the standard and actual results is analyzed is known as variance analysis. Is known as which analysis? Variance analysis. The process by which the total difference between the standard and actual results is analyzed, that analysis is known as what ma? Variance analysis. Understood me everyone? Variance is nothing but when you are comparing just a difference between the standard and actual, that is called variance. When you are analyzing what is the reasons and what are the differences, why the difference is arising between the standard and actual, that analysis is called as variance analysis. Next one, favorable. Next technical definition do we have is what ma? Favorable. So what do you mean by favorable? It is a profitable or favorable situation which arises due to when the actual results are more than expected. When the actual results are more than expected, it is technically represented by the alphabetical letter F. It is technically represented by the alphabetical letter F. Understood ma? What do you mean by favorable situation, Anna? When the actual results are more than expected, then we can say that it is a favorable situation and it is a profitable for the organization, Anna. It is indicated by the alphabetical letter F. Next, what do you mean by adverse? It is a non-profitable or adverse. It is a non-profitable or adverse situation. It is a non-profitable or adverse situation which arises due to when the expected results are less than the actual. It is technically denoted by the alphabetical letter A. It is technically denoted by what, Anna? It is technically denoted by the alphabetical letter A, Nana. Adverse situation. Adverse situation is technically denoted by what? Alphabetical letter A. Okay, na? Next, favorable is finished, adverse is also finished. Next, do we have in this standard costing? Under this standard costing, we understood standard costing is nothing but it is a technique. It is a technique. By using this technique, we are going to compare our standard and with actual figures. We are going to compare the standard and actual figures, and we are trying to analyze what are the differences between expected and actual. This analysis we are calling it as a standard costing. Okay, now under this standard costing, there are two types of cost. One is controllable cost, one is uncontrollable cost. So let us see what do you mean by controllable cost? It represents the cost which can be controlled within the organization. Which can be controlled within the organization. It represents the cost which can be controlled within the organization by taking precautionary steps by the management. By taking precautionary steps by the management. Example for controllable cost is labor timings and elimination of idle time. So labor timings and elimination of idle time means there is no discipline, there is no proper discipline between the employees in the organization. Employees are coming into the organization at their own time and they are leaving at their own time. Coming and going out is their own timings. They are not following a proper timing. Then in that case, that is an internal thing only which can be controlled by the organization by keeping proper timings. Okay, na? Material consumption. Consumption of raw material is also internal thing only which can be controlled by the organization. Means if they are consuming proper quantity of material or not, they are using wastage is more, the wastage is more in the organization, all these things can be controlled by the organization. Next, uncontrollable cost. What do you mean by uncontrollable cost? Uncontrollable cost is nothing but it represents the cost which cannot be controlled or beyond our control is known as uncontrollable cost. So it represents the cost which we cannot control, otherwise it is beyond our control. That we will call it as uncontrollable cost. Example for is increase in tax rates. So tax rates on the products or raw materials is increased by the government. Can you control the tax rates? We cannot control, right? By because it will be decided by the government. Next, increase in price of raw materials. Increase in the price of raw materials. Increase in the price of raw materials is nothing but, suppose in the construction industry we require steel. Can you control steel price in the market? We require sand. Can you control sand price in the market? We require cement. Can you control cement price in the market? We require iron. Can you control iron price in the market? So that is nothing but prices are also external environment which we cannot control. Okay na? Tax rates, prices, all these are external environment which we cannot control. So these kind of costs we'll call it as a what ma? Uncontrollable costs. Okay na? So these kind of costs we'll call it as a uncontrollable cost. Next, after this, under this standard costing, variance analysis will calculate. Variance analysis is nothing but what difference between the standard what we expected and what is the actual. Okay now, this we will try to analysis. Then what are the elements? We will try to analysis here. Under the standard costing, what are the elements we will try to analysis? We know, right? Under the elements of cost, what are the elements do we have? Material, labor, expenses. All these three elements we will analysis. How, sir? I will show you one example. Let's try to understand why we have to do the analysis of the elements and what is the importance of those elements here. What is the motive of a business organization? What is the motto of a business organization? To earn profits or to provide social services. Each and every business organization we are operating. For what purpose we are operating? We are operating for the purpose of profits, right? So profits will be the main motive of each and every business organization. But to earn these profits, what is the main motive of a business organization? The main motive of a business organization to earn the profits or otherwise to provide social services to the public. Main motive is what? Profits. Earning the profits. To earn profits, what they have to do first? They have to do sales, right? To earn the profits, the first thing they have to do is sales. In order to do sales, first they have to incur cost. And this cost okay na? This cost comprises of three elements here. This cost comprises of how many elements? Three elements. What are those elements? One is material, another one is labor, another one is expenses. Okay na? Okay na? So what is the main motive of a business organization? The main motive of a business organization is to earn the profits. To earn these profits, how? they have to make the sales. To make the sales, the first thing is what they require? Cost. They required cost here. Okay. So to the required cost here, suppose let us assume sales is 6 crores. Let us assume sales is how many crores? 6 crores. And let us assume cost is 5 crores. When the sales is 6 crores and the cost is 5 crores, how much will be the profit? The profit will be 1 crore, right? So how much will be the profit here? The profit will be 1 crore. Okay na? So how much will be the profit here? The profit will be 1 crore. So when the sales is 6 crore and the cost is 5 crore. So what is the profit here? 1 crore. Okay. Now let us classify this 5 crores. Let us assume material cost is 2 crore. Labor cost is 2 crore. Expenses cost is, let us assume material cost is how much? 2 crores. And the labor cost is how much? 2 crores. And the expenses cost is how much? 1 crore. Okay. Now, if you see here, let us analyze one by one element now. Let us analyze the one by one element. First, in the current year, there is no demand for our product. Sales has been decreased. There is no demand for our product and the sales has been decreased from 6 crores to 5 crores. Now the sales has been reduced from 6 crores to how many crores? 5 crores. Our sales is also 5 crores and our cost is also 5 crores. Now how much is the profit? The profit will become 0. Means here while analyzing the standard with actual results, due to which reason our profit has become 0. In the last year our profit is 1 crore, but due to some reason the current year profit has become 0. Due to which reason? Due to sales. Means here you have to analyze the sales or you have to analyze all the elements of the cost or all the elements in the organization. Only you have to analyze the sales. Why? Because due to the sales only the profit has been decreased to 1 crore to 0. If you are trying to blame all the departments in the organization, none of the departments will accept such blame. None of the departments will accept such blames. Why? They will say, why you are blaming us? Because whatever the cost which incurred in the last year, the same we incurred. We did not even increase our cost also. We managed, we controlled in such a way. Then they will get, there is an impact that it will create a negative impact unnecessarily on them. If you are trying to blame them, it will create an unnecessarily negative impact on those departments. Now, under this standard costing, we have to analyze due to which element the profit is getting decreased. Now, due to which element? Due to the element of sales. Due to the element of sales, the profit has decreased from 6 crores to, so the profit has decreased from 1 crore to 0 crore. 1 to 0. Now they have to analyze in the last year how many sales we made, in the current year how many sales we made, where we have reduced our sales, in which region, in particular location, in particular product, which product we lost our sales. All these kind of analysis must be done by the management, and the management has to take a proper care so that it will not repeat these situations in the future. For that purpose we will do standard costing. Then the difference between the expected results and actual results of sales, we will prepare one variance here. That variance is known as sales variance. That variance is known as which variance? Sales variance. When we are comparing the standard results with actual results, then the variance is known as which variance? That is called as sales variance. Understood ma? Now I am changing the figure to the original 6 here. Now sales, leave it. Now I am increasing the cost from 5 crores to 6 crores. Now I am increasing the cost from 5 crores to 6 crores, and I am increasing the material cost from 2 crores to 3 crores. I am increasing the material cost from 2 crores to 3 crores. Now, keeping all other elements constant, due to which element the profit is becoming 0? Because of material. Before, the material cost is 2 crores and now it has increased from 2 crores to 3 crores. Now the cost has become 6 crores and the profit has become how much? 0. The profit has become 0. That means here, while analyzing, I have to analyze only the element material. Means in the last year we have to analyze the reason, due to which reason the material cost has been increased. In the last year material price is only 2 crores, now it is 3 crores. Why? Because the government has increased the tax rates. The government has increased the tax rates. Due to that reason the material cost has been increased from 2 crores to 3 crores. Now we have to compare the standard results with actual results. Here that comparison we will call it as a material variances. We will call it as a which variances? Material variances. Understood ma? Here we will call it as a sales variance. Here we will call it as a material variance. Okay na? Next, in the same way, now I am bringing the material into original figure. Okay na? I am bringing the material into original figure 2 CR. Now I am increasing the labor cost from 2 CR to 3 CR. Now I am increasing the labor cost from 2 CR to 3 CR. Now again, what is the total cost? 6 crores. What is the impact on the profit here? 0. Did you observe one thing here? If one single element in the organization is changing, if one single element in the organization is changing, it is having a direct impact on whom? It is having a direct impact on profit only. If a single element in the organization is changing, it will have an impact directly on the profit only. That is the reason, being a cost and management accountant, we should manage in such a way. So all the elements in the organization should be maintained. All the elements in the organization should be controlled. It is important. None of the single element should get disturbed. If a single element is getting disturbed, it will get disturbed on the profits. Okay now, keeping all other elements constant, I am increasing the labor cost from 2 crore to 3 crore. Now how much? What is the impact on profit? The impact on the profit is 0. When the impact on the profit is 0, the comparison between the standard and actual labor cost, that is called as which variances here? It is called as labor variances. It is called as which variances? Labor variances. Okay na? Next, I am bringing this into original position. I am bringing this into original position to CR. Now I am increasing the expenses now. What is the expenses here? 1 crore. What is the expenses here? 1 crore. Now I am increasing the expenses to 2 crores. But here again the expenses, there is a classification. In the case of expenses, we have a further classification. The classification for the expenses here is, okay na, one is fixed overheads, another one is variable overheads. One is fixed overheads, another one is variable overheads. One is fixed overheads, another one is which overheads? Variable overheads. Okay na? So the expenses, we have two overheads. One is fixed overheads, another one is variable overheads. Here the variance which we will calculate, for the difference between actual fixed overheads and budgeted fixed overheads. actual fixed overheads and budgeted fixed overheads, that is called as fixed overhead variances. That is called as which variances? Fixed overhead variances. When we compare between the standard variable overheads and actual variable overheads, that is called as variable overhead variances. That is called as variable overhead variances. Okay na? So these are the different variances which we will calculate under standard costing: sales variance, material variance, labor variance, fixed overhead variance, variable overhead variance. So in the group 1, we have only two variances in the group 1, that is, one is material variance and another one is labor variance. Only these two variances we have in the group 1. Next, in the group 2, we have material variance we have labor variance, we have sales variance, we have fixed overhead variances, we have variable overhead variances. All these things we have in the group 2. Okay na? In the group 1 we have only material and labor. Means if you are studying material and labor variance, again these things will become easy for you in the group 2. Okay na? So this is the overall structure. What are the variances we are going to study? So for what purpose are we are doing this variance? Because any one single element in the organization is changing. It is having a direct impact on whom? It is having a direct impact on the profit only. It is having a direct impact on the profit only. So in order to analyze because of which element this impact is having, to analyze and to identify that element, and we have to control that element, and we should not repeat that expenditure to be incurred in the future. This kind of analysis is known as what? Standard costing. A standard costing is one of the techniques of costing here. Okay now let us take one example and let us derive the formulas. How did we derive in the case of marginal costing? In the case of marginal costing, we took one example. By using that example only, we derived the formulas. By using that example only, we have derived the formulas. Let us derive in the same manner here also. Okay na? Okay ma. So let us take one example. Let us take one example. From that example, let us derive the formulas for material variances. If you study the formulas for material variances, 90% it is same for labor. 90% it will be same for labor. Only 5% will be difference. 95% the formulas will be same. Whatever the formulas we will learn for material, the same formula will be also for labor. Let us take one example. From that example, let us derive the formulas. Okay na? Listen carefully. One single question is enough. If you listen properly, if you listen carefully, one single question, the whole chapter can be solved. Okay na? Listen. The example is this. Standard for 10 kgs of output. The standard is given for 10 kgs of output. There are two raw materials here. One is raw material A. They give 8 kgs. At the rate 6 rupees. B, 4 kgs at the rate 4 rupees per kg. Okay na? Actual is given for 1000 kgs of output. Actual is given for 1000 kgs of output. A, 750 kgs at the rate 7 rupees. B, 500 kgs at the rate 5 rupees. Okay na? So this is the given information ma. This is the given information. See here. So the given information is standard. They give for 10 kgs of output. Actual is given for 1000 kgs of output. The first thing which you have to keep in your mind is when we have to compare the standard with actual. When we have to compare the standard with actual, then the standard and the actual information both should be in a unique platform. Both the standard and actual should be in the unique platform. Otherwise, comparison is not possible. Otherwise, comparison is not possible. In the case of raw material A, how many kgs did they give? 8 kgs at the rate 6 rupees. In the case of raw material B, how many kgs they give? 4 kgs at the rate 4 rupees. Why? Because the standard information is given only for 10 kgs of output. But the actual is for how many kgs of output? Here, the actual is for how many kgs of output? 1000 kgs of output. Based on the actual, always standard will be defined here. Why? Because standard is just our expectations. Standard is not the reality. The standard is just our expectations which we have in our mind. But actual is reality. Actual is reality which happened. Based on the actual, standard will be defined always. Based on the actual, standard will be defined always. Here, the actual is for 1000 kgs. Then we have to convert that standard into actual. Just by adding how many zeros? Because the standard is for 10, actual is for 1000. So that is nothing but just you have to add more 2 zeros. So that is nothing but A will become how many kgs? 800 kgs expectation. B will become how many kgs? 400 kgs. Understood my everyone? So always when we have to compare, both should be in the unique platform. Otherwise the comparison is not possible. Now let us start our comparison. Okay, the first and the foremost variance under the material is, why? Because we are talking about the material only na. We are talking about the material only na, quantity. So that is nothing but material. In the material variances, the first variance do we have is material cost variance. Okay na. The first variance, material cost variance. So what is the formula for material cost variance? I am not going to discuss any formulas. Okay na? We will discuss the formulas in the last. So what do you mean by this material cost variance, sir? Simple. Listen. Material cost variance. The name itself, the meaning is there. Variance. Variance means what? Comparison between the standard and actual. That is called variance. Here which variance we have to calculate? Material variance. Material cost variance means the difference between actual material cost and expected material cost. What is the difference between? The difference between actual material cost and expected material cost. That is only called as material cost variance. Understood everyone? Material cost variance means what? The difference between expected material cost and actual material cost is called as material cost variance. Okay na? Now let us calculate. There are how many raw materials here? 2 raw materials, right? One is A. A is equals to, okay na? A is equals to calculate this material variances, here in the case of standard costing, it is always better to prepare one table first. Okay na? It is always better to prepare one table first. After preparing the table, then we have to calculate the variances. Then the calculation of variances becomes easy by seeing that table, okay na. So what is the table, sir? So let's prepare that table. Table is nothing but the given data I am arranging in a disciplined manner, standard manner, that's all. The given data, whatever the data which is given in this question, I am arranging these data in a one defined manner, that's all. That is only called as a table here. See here, material, standard price, actual price, actual quantity, standard quantity, revised standard quantity, okay na. SPU, the technical terms which we'll use here, SP, standard price, AP, actual price, AQ, actual quantity, SQ, standard quantity, RSQ, revised standard quantity, okay na. What are the raw materials do we have here? One is A, one is B. So the first and the foremost thing which you have to do in the examination is, the first thing is you have to prepare the table. Then afterwards you have to calculate the variances in the exam. Okay na? Standard price. So what is the standard price which is given in the question? For A, 6 rupees. For B, 4 rupees. 6, 4. Next, what is the actual price they gave? A, 7 rupees. B, 5 rupees. What is the actual quantity they gave? A, 750, 500. What is the standard quantity they gave? 800, 400. Okay na? Total 750 plus 500, that is nothing but 1250. This is the actual. Standard is 1200. Revised standard quantity I will talk about later. So revised standard quantity I will talk about this later ma. Okay na. So this is the given information which we wrote. Okay na. Now let us calculate the variances one by one. Okay. Okay na. So this is the given table which you have to prepare in the exam first. Then later we have to calculate the variances. The first variance is material, okay na? The first variance is what na? Material cost variance. Material cost variance means what? The difference between the expected material cost and actual material cost, we will call it as a material cost variance. Okay na? Now what are the different types of materials we have? Two materials is there, A, B. Let us calculate the variance. A is equals to, what is the standard quantity we expected for A? 800 kgs. And what is the standard price we expected for A? 6 rupees. 800 into 6 minus. What is the actual quantity we expected for A? 750. Sorry, what is the actual quantity incurred? 750. And what is the actual price which we incurred? 7 rupees. 750 into 7. Calculate ma. 800 into 6. M plus 750 into 7 M minus MRC. So that is nothing but what ma? 450 rupees negative. 450 rupees negative. 450 rupees negative means we have to represent by adverse. We have to use the alphabetical letter adverse. Why? Because our expectation is only 800 kgs, but expectation is 6 rupees. Actually consumed less, it's good only. 750 only we consumed, but we spent more 7 rupees. 7 means we spent 1 rupee extra here. Okay na? So that is called A. Next B. What is the standard quantity we are expecting? 400. Standard price 4 rupees. 400 into 4 minus. What is the actual quantity? We consumed 500. What is the actual price? 5 rupees. $400 into 4 M plus 500 into 5 M minus MRC. That is nothing but 900 adverse. 900 negative. Negative is nothing but what ma? Adverse. Now raw material A is also adverse. Means it is more than our expectation. We spent more. We spent more than our expectation. B also we had spent more than our expectation. So what is the total variance, Nana? Minus 900 minus 450. That is nothing but 1350 adverse. How much adverse? 1350 adverse. Now this adverse, now this 1350 adverse is due to two reasons. Whatever this 1350 adverse is there, this 1350 adverse is due to two reasons. What are those reasons? One is due to quantity, another one is due to price. This adverse is due to two factors. What are those two factors? This adverse is due to two factors. What are those two factors? One is due to quantity and another one is due to price. One is due to quantity and what is the other one, ma? The other one is due to price. Here we will further analyze. We understood overall it is negative impact. This cost variance, material variance is what? Negative impact. Now this negative impact is due to which factors? Whether due to quantity consumption or price variance, due to which? Then we will further analyze. Here this analysis is called as, one is when we analyze the price, that is called as a material price variance. When we analyze the quantity, we will call it as a material usage variance. Why? Because quantity we will consume. Quantity we will consume. That is the reason here the name is material usage variance. So let us further analyze this. Okay now? Let us further analyze this. One is MPV, material price variance, and another one is material usage variance. Okay na? First one is material cost variance and the second one is material. Why? Because this adverse 1350 is due to two factors. What are those two factors? One is price, one is usage. Correct? One is price, one is quantity. Quantity is nothing but usage. So the first variance is material price variance. Okay, listen carefully now. While calculating the price variance, we have to keep quantity constant. While calculating the price variance, what we have to keep constant? We have to keep quantity as constant. Now, due to which quantity? There are two quantities in the question, right? One is actual quantity, one is a standard quantity. Due to which quantity? The impact will be there. due to which quantity the real impact will be there. Whether due to standard quantity or due to actual quantity, the impact will be there here. This 1350 adverse which we got impact is due to standard or actual. The impact will be there due to actual only. Why? Because the standard is always our expectations. Standard is always our expectations. So due to actual quantity only, the impact will be there. So while calculating the price variance, we have to keep quantity constant. But due to which quantity the impact will be there here? Actual quantity. That is the reason while calculating the price variance, we'll consider actual quantity. So what is the actual quantity for A? 750, B 500. Okay. A is 750, B is 500 into price variance. Price variance means what? Difference between the standard price which we expected minus actual price. Price variance means what? Difference between the standard price which we expected minus actual price. What is the standard price? 6 rupees we expected. What is the actual price? 7. 6 minus 7. What is the standard price we expected for B? 4. Actually is 5. Four minus 5. So that is nothing but 750 adverse, 500 adverse. 750 adverse, 500 adverse. That is nothing but 1250 adverse. That is nothing but how much adverse? 1250 adverse. I hope everyone understood material price variance. Once again I am repeating. See here. Material price variance means what? While calculating the price variance, we have to keep quantity as a constant. But due to which quantity impact will be there? Actual quantity. So actual quantity into. Price variance means what? Difference between the standard and actual. So standard price minus actual price. That's all. That's all. Next. Calculating the material usage variance. While calculating the material usage variance, we have to keep price as a constant. We have to keep price as a constant. Here there are two prices, standard price, actual price. Again, we should not consider here actual price. Why? While calculating the price variance, already we considered price there. Again, if you are considering, it will become a double effect here. That is the reason we should not consider actual price. So which price will remain constant throughout the year? Standard price. Which price will remain throughout the year? Constant. Standard price will remain the constant. Now let us calculate the variance. A is equals to B is equals to. What is the standard price they gave for A and B? 6, 4. 6, 4 into. Usage variance. Usage is what? Difference between standard quantity and actual quantity. Usage variance is equals to what? Difference between the standard quantity and actual quantity. What is the standard quantity? 800 minus actual quantity 750. Here 400 minus 500. $800 minus 750, 50. 50 into 6, 300. Favorable. 300 favorable. 400 minus 500, 100. 100 into 4, 400 adverse. 400 adverse, 300 favorable. What is the net? 100 adverse. So what is the impact here? 100 adverse. Did you observe here one thing? Material price variance plus material usage variance is equals to material cost variance. See here, 1250 adverse, 100 adverse. 1250 plus 100 is equals to 1350. So material cost variance is equals to what is the formula here? Material price variance plus material usage variance. This will be the formula. Understood everyone? Next. Here again we have to subclassify price and usage. Unfortunately, we cannot further analysis price. Unfortunately, we cannot further analysis price because price is an external environment, internal environment. Price is an external environment which we cannot control. Price is a external environment which we cannot control. That is the reason further analysis of price is not possible. Then further usage is internal only. Usage is internal only. So control of usage is possible. So let us further analysis usage. When you are further analyzing the usage, when we are further analyzing the usage, then we have two formulas here. What are those formulas is, first one is material yield variance and the another one is material mix variance. One is material yield variance, another one is material mix variance. To calculate this material yield variance and to calculate this material mix variance, okay na, in order to calculate this yield variance and mix variance, okay na. So in order to calculate this yield variance and mix variance, we require a revised standard quantity. What do we require? Revised standard quantity. So what do you mean by this revised standard quantity, sir? What do you mean by this revised standard quantity? Okay na? Revised standard quantity is nothing but when there is a difference between your actual quantity consumed and standard quantity expected, then we have to revise our standards. When we have to revise our standards. See, what is our standard expectation? 1200. But what is the actual consumption? 1250. That means we have to revise our standards because our standards are not sufficient. Our standards are not matching the actual. Our standards are not reaching the actual. That is the reason we have to revise our standards. Okay now always this actual quantity will become revised standard quantity. Always actual quantity will become revised standard quantity. So what is the revised standard quantity here? 1250. Always actual quantity will become revised standard quantity 1250. Now let us calculate revised standard quantity. Calculation of revised standard quantity. Okay na? Here this revised standard quantity will be always apportioned in standard ratio. Apportioned in which ratio? Standard ratio. What is the standard ratio here? 800, 400. Two is to 1. So what is the standard ratio here? 2 is to 1. Let us calculate the revised standard quantity for A. A revised standard quantity is equals to, okay na, 1250 into 2 by 3. B 1250 into 1 by 3. How much more? 833.33 kgs revised standard quantity. Okay na? Next, what will be the B revised standard quantity? $416.67 kgs. Okay na? 416.67 kgs. This is the thing. Okay na? A is equals to how much ma? 833.33 kgs. B is equals to 416.67 kgs. This is the revised standard quantity. This is which quantity ma? Revised standard quantity for A is 833.33 and B is how much? 416.67 6.67 kgs. Okay na? This is the revised standard quantity. Always actual quantity will become revised standard quantity. Actual quantity will become revised standard quantity, and this revised standard quantity we have to apportion in which ratio? We have to apportion in the standard ratio. Which ratio? Standard ratio. So we got the revised standard quantity. How much? 833.33 416.67. So this is the revised standard quantity which we got. Now the formula for the yield variance. What do you mean by yield, sir? Yield is nothing but return. Yield is nothing but return. Okay na? Now you see your yield. What is your yield? Positive or negative na? You expected your standard 800, but what is your revision? 833.33. Means your expectation is not reaching your revised. Revision is more than your expectation. That is nothing but your yield is negative. Your yield is negative. You expected 400 for B, but what is your revision? 416.67. Means your expectation are not reaching your revision. Okay na? So the formula will be comparison between the standard quantity and revised standard quantity. Comparison between the standard quantity and revised standard quantity. That is called as a yield variance. That is called as a which variance ma? Yield variance. There are two materials na. A, B. Okay na? A. So what is the standard price for usage? The same thing we have to take 6.4 into. What is the standard quantity you expected? 800 minus. What is the revised standard quantity? 833.33. What is the revision you expected? What is the standard you expected? 400 minus 416.67. Okay na? So this is called the difference between the standard quantity and revised standard quantity. This is called as a which variance? Yield variance. That is called as a yield variance. 800 minus 833.33 into 6. So that is nothing but 199.98. That is nothing but 200 adverse. 400 minus 416.67 into 4. That is nothing but 66.68. That is nothing but 67 adverse. 267 adverse. How much is the yield variance? Yield variance is 267 adverse. Okay na? Next. Mix variance. What do you mean by mix variance? Yield is nothing but difference between standard and revised. That is called a mix. That is called yield. Difference between the standard and revised is called yield. Then what about mix variance? Mix is nothing but difference between revised standard quantity and your actual quantity. Difference between revised standard quantity and your actual quantity. That is called as a revised standard quantity. Now let us calculate for mix variance. A. Your revision is how much? 833.33 minus. What is your actual? 750. B. $416.67 minus. What is your actual? 500. You have to multiply with standard price into 6 into 4. So that is nothing but 500 favorable. Okay, 416.67 minus 500 into 4. That is nothing but 333 adverse. That is nothing but how much more adverse? 333 adverse. 167 favorable. So how much is the favorable ma? 167 favorable. Material mix variance. Now material usage variance is equals to, what is the formula we can use? Yield variance plus mix variance. Yield variance plus mix variance, that is called usage variance. What is the yield variance you got? 267 adverse. What is the mix variance? 167 favorable. So that is nothing but, what is the difference here, Nana? The difference here is nothing but 100 adverse. What is the difference here? 100 adverse. That is called usage variance. You can see, cross check the formulas. So what are the formulas we can write here, Nana? The formulas which we can write here is, see here. One is material cost variance is equals to material price variance plus material usage variance. This is the one formula. Next, material usage variance is equals to material yield variance plus material mix variance. Okay, na? So material cost variance is equals to, what is the formula? Material price variance plus material usage variance. So these are the two formulas which we will use, Nana. Material cost variance, material usage variance. Now let us see the formulas. Material cost variance is equals to, what is the formula? Material cost variance is equals to, what is the formula here? Okay, na? Material cost variance is equals to, what is the formula, Nana? Here material cost variance is equals to, what is the concept, Nana? Difference between the expected standard cost and actual standard cost, that is called as a cost variance. So what is the formula we can write here? Standard, expected is nothing but standard quantity into standard price minus actual quantity into actual price. What is the formula we can write? Material cost variance is equals to standard quantity into standard price minus actual quantity into actual price. Okay, na? Next, material price variance is equals to, what is the formula we can write here? Always we have to keep, while calculating price variance, we have to keep quantity as constant. But because of which quantity, the impact will be there? Actual quantity. Actual quantity into standard price minus actual price. This is the formula. Usage variance is equals to, while calculating the usage, we have to keep price constant. Which price will remains constant? Standard price into standard quantity minus actual quantity. Yield is nothing but difference between standard and revised. Standard price into standard quantity minus revised standard quantity. Mix variance is equals to standard price into revised standard quantity minus actual quantity. So these are the formulas. These are the formulas for variances. Okay, na? So what is the first formula, Nana? Material cost variance is equals to standard quantity into standard price minus actual quantity into actual price. Price variance is equals to actual quantity into standard price minus actual price. Usage variance is equals to standard price into SQ minus AQ. Yield is equals to SP into SQ minus RSQ. Mix is equals to SP into RSQ minus AQ, Nana. Okay, na? So these are the formulas we have. So complete, if these formulas you understood, same similar to this labor variance formulas will be there. Okay, na? Okay, ma. So Now we finished with the formulas. Let us cross check. Material usage variance is equals to, sometimes what happens, people may confuse about the formulas. Okay, na? Sometimes people may confuse material yield variance and material mix variance. To remember material yield variance, it is very easy. That is the reason I framed the table like this: SQ minus RSQ. Standard quantity minus revised standard quantity. So that is nothing but material yield variance. Material mix variance is equals to RSQ minus AQ. Okay, na? To cross check also, you can do this formula. You can use this formula for cross checking also. How, sir? I will show you. See here. Material usage variance is equals to material usage variance is equals to, okay, material yield variance plus material mix variance, correct? So yield variance is equals to, what is the formula we have? What is the formula we have? Standard price into standard quantity minus revised standard quantity plus yield variance is equals to, what is the formula? Revised standard quantity minus actual quantity. Yes or no? This is the formula, right? Material yield variance plus material mix variance. See, when you are writing this formula, here in the yield it is minus RSQ, gets cancelled, with here plus RSQ in the material mix. So what is the final portion which is left here? Standard price into standard quantity minus actual quantity. Standard price into standard quantity minus actual quantity is nothing but what you see here. Standard price into standard quantity minus actual quantity, that is nothing but what? Material usage variance. This is how you have to cross check whether the answer which you wrote correct or wrong in the examination. In the examination, this is how you have to cross check your answer in the examination also. Okay, next. All the formulas together one place, let us write, and then let us move on to the questions. For solving the questions, there are different methods available, standard costing, but the method which I will follow is easiest method and unique method. Okay, first thing, you have to gather the information, you have to form the table. Once this table is formed, 70% of the question is finished. Remaining 30%, just you have to apply the formulas and you have to do the calculations. You have to apply the formulas and you have to do the calculations. Okay, first formulas of material variances. First one, material cost variance. Material cost variance. Material cost variance is equals to, what is the formula now? Standard quantity into standard price minus actual quantity into actual price. Next, material price variance. Material price variance is equals to, what is the formula? Actual quantity into standard price minus actual price. Material usage variance is equals to, what is the formula? Standard price into standard quantity minus actual quantity. This is the formula for material usage variance. Next, material yield variance. standard price into standard quantity minus revised standard quantity. Material mix variance, standard price into revised standard quantity minus actual quantity. So these are the formulas majorly which we will use for the material variances. Okay na? Okay na? So these are the formulas which we are using for material variances. Material cost variance is equals to, what is the formula? Standard quantity into standard price minus actual quantity into actual price. Here you have to take a note. Always standard quantity will be defined from actual quantity. Okay na? Always standard quantity will be defined from where? It will be defined from actual quantity. Okay na? This is what you have to keep in your mind. Standard quantity is not given in the question, then it will be defined from actual quantity. So this is the complete theoretical part about the standard costing. So this is how we will derive the formulas for standard costing. Okay, so keep in mind these things. So the first step is you have to frame the table. Second step is you have to apply the formulas by remembering the concept, not by bugging up the formulas. Different people will have different strategies, but this is the best strategy which I found. Okay, now for standard costing, let us start with the questions.